First and foremost, this is not tax advice. These are tax considerations. And you need to consider some things when you're dealing with this change. You see what I'm saying? Ain't no jokes. You feel me? You got to take care of Uncle Sam. Jesus said it best. Render unto God what is God's, and render unto Caesar what is Caesar's. AKA pay your taxes. And there's some tax considerations you gotta have, you gotta take. Even if it's gifts, even if it's income, investments, alternative medium of exchange, that's what we use. And nevertheless, it does not mean you can't get taxed, depending upon your form of institution, entity, agency, the type of company you are. It's percentages and things. People got to get their change. So these some tax considerations. Hey, so look, we know what tax is all about. Tax time. We know what tax is about. So look, Flip, let them know what the artisticness of this is looking like. And then we're going to get Alex, go ahead and break it down to them about these tax considerations, whether it's gifts, investments, income, whatever. You got to consider some things when dealing with this change.
Tax considerations. When transferring value, it is important to first identify the legal and economic nature of the transaction, since tax treatment is generally based on the substance of the transfer rather than the medium used to complete it. When value is transferred as a gift, as compensation for services, as an investment through the realization of capital gains, or as undistributed capital gains, each category may be subject to different accounting, reporting, and tax requirements under applicable law. Maintaining accurate records of the parties involved, the date of the transaction, the amount or fair market value transferred, and the purpose of the transaction is essential for proper financing reporting and tax compliance. Gifts are generally distinguished from compensation because they are transferred without the expectation of goods, services, or other consideration in return. Compensation for services, wages, commissions, consulting fees, or other earned income is typically taxable to the recipient and may require reporting or withholding by the payer, depending on applicable laws. The classification of a transfer is therefore determined by the underlying relationship and purpose of the transaction rather than how the value is delivered. Investments and capital gains involve additional considerations related to the ownership and disposition of assets. Investment income may include interest, dividends, royalties, or other returns, while capital gains generally arise from the sale or exchange of capital assets. Some investment entities may also retain goods as undistributed capital gains, which can affect an investor's tax basis on or reporting obligations even when no cash distribution is received. Proper documentation of acquisition costs, holding periods, dispositions, and adjustments help ensure accurate accounting and compliance with applicable tax regulations. Use of alternative mediums for exchange, such as spiritual and formal value transfer systems, do not by itself create inherently different tax principles than those that apply to taxations deducted through traditional financial institutions. In general, tax authorities focus on the nature, value, and purpose of the transaction rather than the payment mechanism used to transfer value. Whether value is exchanged through cash, bank transfers, community currencies, digital tokens, barter arrangements, or other lawful transfer systems, the same fundamental accounting and tax concepts such as income recognition, valuation, documentation, and reporting generally continue to apply. However, the operators of such transfer systems may have additional regulatory obligations under financial services that are separate from the tax treatment of the underlying transaction. Regardless of the transfer method used, individuals and organizations should maintain complete and accurate records supporting every transaction. Documentation to identify the parties involved, the type of transfer, the date, the value exchanged, and any supporting agreements or evidence necessary to substantiate the transaction. Because accounting standards, tax laws, and financial regulations vary by jurisdiction, taxpayers should ensure that transfers are recorded consistently and in accordance to applicable legal requirements, seeking professional advice when appropriate to support compliance and sound financial management.
Yeah, that was some real tax talk. You feel me? got that on wax chalk. Because it's real. It's real. Taxes is real. It's real in the field. So consider them things. Page 24 ain't no joke. You gotta have your tax considerations. You feel me? We are not responsible for doing your taxes for you. This is a spiritual, informal value transfer system. We're gonna make sure everything is there for you to ensure that you are properly reporting, properly get all the data that you need, the evidence of all the transfers. Valuation matrix is on point. But you gotta do what you gotta do. Take the right tax considerations, make sure everything in alignment so you can get what's yours. Forgiving what you have given. That love is real. Love do pay the bills, and just like that, we just went 22 for 22.